The banking crisis is actually a Treasury bill crisis. Why is that? Why is nobody covering that? You reach the Financial Almanac on Basil and I'll explain it all to you. I'll connect the dots. So why is the banking crisis actually a hidden, covert operation for the crisis of the Treasury bills? Well, remember Russia? Russia had their sanctions done on them where the government of the United States said, you can no longer redeem your Treasury bills in your reserves in your central bank. You can no longer use the SWIFT system to interact with the planet. You can no longer redeem your dollars for any goods around the world. And companies said, hey, we're backing off from Russia. Oh, we're closing down this business, closing up shop, and they left. Remember all of that? That sent signals around the planet. Shockwaves, like a bat signal. Hey, look what we could do. The United States government did, and they knew they could do that power, but it's a one-time bullet. This signal that sent shockwaves around the planet basically split the world into two political divisions, NATO and Russian allies, right? Now, there were some countries that were sort of in the middle, undecided, said, hey, we're going to step out of this, but we just saw that our monetary system could be weaponized and we can be cut off. Basically, our reserves, our treasury reserves, and our balances can be depleted to zero. Imagine, you have billions of dollars. You're South Africa, you're Egypt, you're whatever country. And now you're telling me that the United States government at any time they feel like, right, if we don't follow a policy, if we don't want to give up land, they can just make our treasury bills that we hold for this foreign government into zero. Countries started to plan a contingency and hedge against this action. And that's where it all started, right, during that event. And then there's China. China for the last 30 years, since the Bill Clinton era, where they exported jobs to China because they had cheap labor to make all this amazing stuff we use in our consumer-based society, basically bringing up their classes from lower class to middle class to upper class, right? We all know that story. Everything's been made in China when we were growing up as children, right? Because we were sending so much money to them and they were sending so much materials to us, right? We were sending them fiat. They were sending us goods. They would take that fiat and reinvest it back into our economy by buying treasury bills for their, central bank governments reserves so they can trade with other people using, the international currency standard, the global reserve of the United States dollar. The United States also bought military weapons from them. And we started, creating military bases around China. So we're sending them fiat. They're sending us materials to build bases surrounding China. How long do you think that will be okay with China before they say, hey, we're going to cut you off? Well, at least there's a vulnerability there. You might not think China will be cutting us off, but there's definitely something that, raised their red flags. And they said, hey, you better watch what you're doing because you're using, so that's a point of weakness, right? And I'm sure the government sees this, right? It's unsustainable, essentially, is what I'm saying. Because of our bases surrounding China slowly over time and Russia, all of this is pushing them together. Russia has a lot of commodities, right? So when we sanctioned them, right, and they can no longer send a lot of their oils and natural gases around the planet because we cut them off from our system, the SWIFT system, what did they do? They used India, they used China, they used all these countries to backdoor black market sell their oil. They gave them a discount. The discount that they took said, hey, India, here's a discount for your oil. Go sell it to somebody else. Go sell it to Iran. All right, so India's like, hey, no problem. Boom, they made a cut. India is the middleman. Same thing with Europe and Germany. Europe and Germany was entering into a winter. Oh my God, what are we gonna do? It's gonna be terrible. We're gonna freeze. We saw oil hit 120. You know what I mean? We saw natural gas skyrocket to like $10. You know what I mean? It was ridiculous. Nord Stream pipeline had its exploded. It's basically forced Russia to stop sending supplies to to Europe and Germany. We all know who did that, right? Lucky for Germany and Europe, they had a warmer winter than expected. So it wasn't as bad. It wasn't pleasurable, right? But it wasn't as bad. So that basically saved quite a bit of European and German economy. With Russia, the way it's standing today, right, with their commodities and their military, think of them as like a gas station with an army, right? And they have allegiance with the manufacturing country of the world, the industrialized China, and then they have India, they have Brazil, they have South Africa for the BRICS nation, right? And then they have applicants coming in as well. So there's this allies basically trading right? Not only just natural gases and even oil, they're stepping away from the petrodollar into the petro-yuan, the petro-ruble, whatever, right? They're bypassing the sanction that we can impose on them because of what we did to Russia. So how does that all affect the treasury bills? There was a time when countries would go buy the US dollar treasury and put that in their reserve, in their country's reserve. The central banks would hold large amounts, and they still do. There's still a large amount of treasuries being held by them, but it's been reducing the last few years. Right? It's been at 70, now it's like at 55. And so these countries are now supporting more gold in their treasuries, buying less treasuries. But our Treasury Department, right, is still printing the same amount that we used to sell. But now the demand has dropped and our treasuries are still building this many treasuries. Now, when we are backed up with our supply, but the demand isn't there as it once was, because now they've said, hey, you can sanction us. You can drop your treasuries to zero and cut us off. You sanctioned us before with Russia. We saw this. We don't want to get involved into this weaponized system, but we're going to have to hedge against this just in case for our people in our country. So we're going to buy gold now, right? So we see that happening on the planet. But our Treasury, Janet Yellen's department, is still printing treasury bills. But there's no demand. So what are we doing with all these treasury bills? When you increase the supply of treasury and the demand isn't there, let's say you have a bond worth $100 that gives you 2%, but nobody's buying it. So you're like, you know what? I got to increase the yield so it becomes more attractive for people. You increase the yield to say 4%. Which one are you going to buy? A bond that gives you 2 or a bond that gives you 4? You're going to buy the one that gives you 4. But what happens is instead of it being $100 at 4, because the first one was $100 at 2%, it goes from $100 to say like 90, right? Or 80 or whatever that math is, right? As yields go up, the price goes down. And so now you're buying a bond that gives you 4% at $90, right? And so that's very attractive for the economy. They're still buying them, but not the same volume as they used to because we sent the shockwave warning signal that we can weaponize this system. So what is the Treasury doing? They're forcing it on our banks. They're forcing the lack of demand that naturally happened across the world before Russia was sanctioned. And now they're taking that demand and forcing our regional banks, our mid-tier banks, right, to buy these treasury bonds. There's no more buyers, right? So we're forcing our own banks to pick up these treasury bonds. And so when we see these crises happening, they're not just because, one mismanaged, that they were over leveraged for 55% of their books for a long dated duration. Yeah, that's definitely one problem. We have almost like just between, 4,000 to 5,000 banks, right? It used to be 14,000 and over time it used to diminish for other reasons. Now, the regional bank crisis that we may see isn't just, people going and withdrawing their deposits. It's the fact that they're holding treasury bonds. Now, what happens when a country that says, hey, you know what? We're no longer going to be buying your treasury bills. We're going to be buying gold. So actually, we want to redeem some treasury bills. So they take the treasury bill, they go to the Federal Reserve, they give the treasury bill to the Federal Reserve. The Federal Reserve gives them fiat, the US fiat. That increases supply, right? And then they're like, oh, slowly we're going to get rid of, all our treasury bills, and slowly over time buy commodities like oil and gold, right? And whatever currency that the BRICS nations want to do, commodity based, right? This inflates the amount of US dollar in circulation and lowers the amount of treasuries around the world in circulation and increases the domestic amount of our bonds, of our treasury bills. Because regional banks here have to pick them up. Our mid-tier banks will have to pick them up. Our large cap banks will have to pick them up. Everything's becoming so concentrated where if there's 1 or 2 weak points, guess what happens? It starts to explode and there's a whole cataclysm of taking banks from, 4,500 banks down to 2,000 banks. Remember when we wanted sanitizer? When we wanted masks? When we wanted diapers, toilet paper, not too long ago, you know what I mean? Where did that come from? It came from China. Remember that supply crisis? The container shipments are being backlogged and oh my God, there's nothing on our shelves. Where is China? That sent another signal around the world on top of what we did to Russia, saying, hey, the supply chain, the manufacturing industrial sector for the United States is super vulnerable. Oh my God, these guys are, they're on our calcium cannons. It was terrible, right? The world saw our Achilles heel. We used to be the Industrial Revolution, the forerunners of the planet's next age. Now we're relying on China for diapers and hand sanitizer and masks when there was a global crisis. So this sent shockwaves throughout our government, right? The military, the Pentagon, our allies in Canada, saying that, hey, we need to bring industry back to our soil. How do you do that when your system is based on workers getting, a decent living to sustain yourself, but then you want to have materials in your consumer-based society affordable? You do that by exporting, your source of labor to a cheaper country because their hourly wage cannot compete with us, and so it's cheaper to manufacture things over there and you bring it in. That's what we did. But when you want to industrialize your own country and you want to make sure that things are a little bit more competitive, industrially speaking, materially speaking, you need to lower the hourly rate here so it's more affordable for the corporatocracy, right? To bring industry back to our soil. You want to make it more affordable. The bottom line matters for these companies, as we know. So if you want to onshore industry back to our soil, you're going to have to drop the minimum wage quite a bit, or not even minimum wage. You're just going to have to inflate the dollar. And that's what happens. When countries no longer buy US treasuries and they're saying, hey, we're just going to buy gold. And you know what, United States Federal Reserve, here's the treasury, give me back the dollar. And then they're going to, we're going to reinvest that back into your economy because slowly we just want to detach, right? We're going to give you back what you gave us, right? We're going to take that and buy gold and here's your US dollar back. That's going to increase our supply domestically of dollars, right? The Federal Reserve doesn't have to do much anymore once it gets to that critical situation. That critical situation might be at the end of this decade. I'll just say that, right? It's hard to predict time, but I'm gonna guess by the end of this decade, right? Before or around 2030. And so we're gonna have this inflationary system where the wages are not keeping up with it, and then it'll be more lucrative to bring back industry, silicon from Taiwan, manufacturing down to here, right? To the US, to Canada even, right? If industry manufacturing comes back here, we will need a weaker, a lower class of workers to be able to afford the volume we need to make to resupply the world, but even just for ourselves. You know what I mean? And that's a huge vulnerability, and the banking crisis is definitely sort of helping them do this. That's why CEOs and executives and directors can get a bonus, because it was part of the plan. The federal government, saying, hey, we need to reshore our industry here. This is our 10-year plan. And how the way we need to do this is we need to centralize a few things to have more control, and we need, you guys to buy our treasuries, and then you guys will just explode. And rather than the Treasury Department, of course, that's how it's all snowballing down the road. So we see that government, countries, and their treasuries around the world are reconsidering how they can reallocate what they have into gold and away from treasuries, from the United States treasuries, right? So I've covered that. But did you know at one time there were two reserves for treasuries around the world coming from the United States? One is the treasuries that we're talking about today. But before 2008, it was mortgage-backed securities. Mortgage-backed securities were held by so many entities and governments and treasuries around the world that said, hey, no problem. We'll do this mortgage-backed securities and treasuries. Bada bing, bada boom. 2008. What happened? Half of the treasuries, well, not half, but a large portion of their treasuries held in mortgage-backed securities did absolutely abysmally. So that was the huge financial crisis that happened. that was the domino, because so many countries held them, and one of the two reserve things that people held in their treasuries collapsed. They're like, you know what, we're not going to do mortgage-backed securities anymore. Let's just convert them all to treasury bills, right? And so now these treasury bills are being sold for gold, and all this cash is coming back to the United States, and hence the inflation that we're experiencing. That's like, hey, job markets and people are spending less. The credit card debt and line of credit debt is at an all-time high. Where's all this money coming from? It's coming from outside of the country because people are redeeming their treasury bills. Not only that, our Treasury Department, like I said, are keep printing, right? So that's why we're getting better yields in our bank today. Money market accounts, Treasury bills yielding you 4 or 5%. Amazing. And guess where? Guess where you have to buy them? You're buying them at your regional banks, right? So they're flooding the market again with Treasury bills because nobody's buying them, right? So you have to increase the yield, and so that's doing well in our regional banks. While meanwhile, other countries are saying, "Oh, we see what's happening here. You can sanction and use the treasuries as a weapon, and our dollars might be nothing to you if we don't align with your philosophies and your national politics and your global affairs." So here's our treasuries, here's our US dollars. We're slowly going to be increasing our commodity holdings and make new trade agreements around the world. And the US is left holding the bag, especially the taxpayer, especially the consumer, the citizen, and the civilians. We also see not only governments and central banks around the world increase their allocation to gold, we also see this happen here domestically in the United States as well, where we are increasing our purchasing for gold as well, right? And so the reason for this is because we are still the standard for global trade, right? We're still the hegemony for global currency standard. And in order for us to be more accepting by the global community to do more business, right, to continue business as it was, we need to basically do our currency exchanges, right, and then settle in gold, right? So this is where things are going, right? We're going to be settling in gold. It might be float. I don't think it'll be premium, meaning it'll be in possession. It'll be in the float chart, right, on the stock market. That is how things are pretty much looking on the way it's progressing as things unveil. So we saw that during the Trump administration, he wanted to onshore manufacturing back on our soil, right? And now Biden is talking about $50 billion will help with semiconductors, and we will increase the manufacturing here. And we know that we are in severe need of laborers and industrializing our manufacturing department. We are severely short on that sector. If anything, COVID has made that loud and clear, right? So what I'm worried about is this, and this is completely speculation on my end. This is just my opinion, right? Nobody has influenced my decision. This is what I believe will happen. That now that, government regulators are forcing the treasuries to be bought up by, regional banks and, well, not regional banks, all banks essentially, including our ally banks. And, they're regulating it into money markets to give these, yields that people are really happy about because of, cost of inflation is so high. So it's great to have these stronger yields to help mitigate that situation. What will happen is as, we're starting to see already that there's a huge volatile nature in these treasury bonds. We're seeing massive swings, right? And so as the volatile nature gets to a certain point and, the market is saturated in regional banks that are buying up treasury bills and the money market is being regulated with this as well, it gets to a point where the Federal Reserve will have to buy these treasuries, right, to offset the amount that's being printed to keep the economy going. That's going to flood the market with dollars, and that's going to cause a US dollar crash, right? It's going to severely reduce the purchasing power of the dollar, right? And, things like gold and Bitcoin and things that are a little bit more speculative, high risk during this turmoil-based hypothetical situation I'm speculating on will do very well. If that were to happen, what will happen is, like I alluded to before, that will increase the opportunity for manufacturers to come back because our dollar is weaker, right? And I will say, hey, the cost of creating semiconductors and other manufacturing sectors in our industry will be more opportune with a weaker dollar to increase our manufacturing back on our soil. Now, this will be a slow play. This won't happen fast enough, in my opinion, right? I don't want to hurt anyone in the economy, obviously, but this needs to be done a lot quicker, and I don't think it'll move as fast as it should be to bring back our manufacturing sector. Instead of the Biden administration spending 50 billion, they should really spend 100, maybe 200 billion. But anyways, he's getting a lot of credit, even though, this is Trump's plan. They're really both of the same bird, right? They're just two sides of different wings, but it's the same bird. The plan at the end of the day will benefit Americans, even though there will be a huge struggle in the future unless we reallocate our assets into things that will do well during this inflation occurrence that will take place. Now, I'm not sure, obviously, on how it'll be rolled out, but I'm guessing there'll probably be another viral crisis that will come out, and the government and the Federal Reserve will say, okay, we need to flood the economy, let's buy treasury bills, and that's how it'll be covered up quite a bit, and people will be like halting, and the dollar's collapsing, things will start to pick up again. Oh, we need to save ourselves, so let's increase our manufacturing. That might be played out, unfortunately, where there might be that psychological fear factor in our economy. I do think that might be the most likely chance that our governments will have to basically enact again, and that will help bring not only manufacturing here, but it'll also give the Federal Reserve a reason to buy back the highly volatile nature of the treasury bills that are coming back onto our shores. That way they can flood the dollar into our system because they're buying back all the treasury, and this will create another wave for the next decade up to 2030, and from there CBDCs will be enacted, and the Fed Now policy and the UMU and all these other CBDCs around the world will say, hey, now that manufacturing's coming back, it's the opportune time to present the CBDCs. Let me know down below if you want me to get into central bank digital currency. I can cover that in the next video and how this all might play out. Let me know down below if you want to see that. Some of you may say, okay, I understand what you're presenting. It's complete speculation. But where do we go from here, right? What are the possible paths that we may take? Well, it depends on what side of the government wins. So there's two sides to this sort of idea, right? The first side is basically of the idea that, what is good for the bond market is good for America, aka Washington. And these are guys like Larry Summers, Robert Rubin, certain Washington interests, Wall Street, and people that believe that, if we lose global currency status that we've established in the last 50 years or so, then, and we lose that hegemony, then it's the end of the world for us, right? So that's one side of the aisle. Now, mind you, that same aisle really believes that it's okay if unemployment reaches 6 or 8% and inflation comes about because we are saving our currency and our hegemony, and that is the bottom line, to save the bond market, right? They're okay with a high unemployment rate. So in the second aisle of debate, which would be from public releases, we can see most of the Pentagon, certain intelligence agencies, and certain industrial manufacturers are also of the same mind, saying that we cannot really challenge and fight a war against China if we're borrowing against China, if we're going to buy components from China, and to face down against China. That's not really sustainable, right? It's not a good look. So that's that second half of the debate. Where I basically stand, right? My speculation is before COVID, right? It was okay to, have the system based around bonds, right? That made sense, and it helped to offshore our manufacturing industry sector to have cheaper products here, right? That made sense. After COVID, anyone with, half a brain can see that we were very vulnerable, right? You can see what mothers were going through when they were trying to find diapers. It was terrible to see that in person. It was terrible to see that nobody can go out because they didn't have enough hand sanitizers, and we were begging shops for, hand sanitizers and masks and all this other stuff, right? So that made sense. The bond market argument for the first debate made sense before COVID. After COVID, that basically said, hey, we need to reprioritize how we are going to last for the next century, right? And so this is where I am of the mind it shifted from this half of the wing to this half of the wing, where now we will have to reshore, bring back industry over here. In order to compete against the world, we'll have to lessen our dollar. That way people can come and purchase from us again, because it's okay if our dollar is strong and it's just everything is basically still over here, nothing's going to be made here. Things are still going to be made in Bangladesh or wherever they're made, right? And things are going to be imported. And it's okay to have an importing sector, but there's certain things we need to have domestically, at least a bare minimum threshold, right? Just the bare minimum. Anything below that is crisis situation, as we saw. So we need to lessen our dollar, not completely like Bangladesh or anything like that, right? But to lessen to the point of our purchasing power of our dollar, to onshore the sector again of manufacturing, right? And this is what I believe the situation is going with the Treasury crisis, that leads into the bond crisis, that leads into the banking crisis, that will lead into the Federal Reserve eventually pivoting in 2024 when things get really hairy. And that's when the next wave of whatever comes about our system, and there's a whole new flu season, and everything is, I don't have to paint a picture. We just came from that, but we have to get ready for that next cycle and make sure we have assets in our possession and resources while this unfolds, because this is restructuring the globe. We cannot just think that the BRICS nation and us sanctioning Russia and us surrounding China with Chinese manufactured goods is the way that is sustainable. It just simply is not. And I think the world sees this, and we are getting our act together, but it's going to be painful, right? So I know this isn't pleasant news, but please hit that like button. It took a lot to put this together and do the research. Make sure to subscribe and let me know your thoughts down below on whether I'm completely bonkers and I lost it like, Joe Biden, and you guys need to advise me on what to do and what to say, or if you think I hold some water in this thesis of mine. That's completely speculation. None of this is financial advice, but I do see things rolling out this way. So there's a few outcomes that this may fall into, right? Which side will win, right, of the debate. I can think of maybe 3 or 4 options that might ensue. Option number 1, where the bond market wins and we start exporting treasuries again outside of our country, and these governments start picking up our treasuries again. In order for that to happen, basically we have to remove Putin from Russia and put in a guy like Yeltsin or somebody a little bit more liberal and soft to take charge of that country. And that is going to be very hard to find somebody to replace him, actually. Having achieved that, we'd be able to trade US dollars with commodities and energies around the world again and reestablish ourselves once more. Now, with that in place, we'll be able to buy oil again for cheap from Russia, and China also would have to, change 180 on a lot of their initiatives, the 2025 initiative, the Belt and Road initiative, and they would have to change their stance on Taiwan quite a bit as well, and basically fall into place as they were 10 years ago, around 2014, when they were basically a subsidiary of the Reserve, right, the Fed. So that's how option number 1 looks like, where the bond market and we get to export the treasuries again, and commodities now in oil are backed by US dollar, the petrodollar strengthens again, and Russia gets a facelift, and China goes back to essentially the pre-2008 world, right? Which is very slim. Not all of this will happen. Option number 2 isn't really likely because it's discovering a new form of energy to change our planet to the point where it has to be like nuclear fission, right? This has to be like a Manhattan scale level of project, right? And nuclear fission isn't going to be readily available this quickly because we're not seeing major developments on that front, right? So the energy situation isn't going to have a major revolution anytime soon. So option number 1 and option number 2 aren't really that strong. So I find option number 3 and option number 4 most likely. Option 3 being that the treasury supplies continue to back up and foreign governments do not purchase those treasury bills anymore, right? So our backup, we're being backed up by our treasury supplies. Not only that, with the recent Federal Reserve increasing rates at the rate that they did, this increases the amount of UF deficit that we build on our balance sheets. So as we have a backup of treasury bills on our hand, what will happen is how much they will cost will go down, their rate of yield will increase, their interest rates will go higher, and this will basically cause a slowing economy as we enter into a recession. And from there, the dollar demand will be even more deflationary in a way, where the cost of accessing dollar will be quite vital because the stock market will correct as well as the bond yields increase and get stronger. Now, with yields going up and the stock market correcting, there'll be less revenue for the economy in this recessionary period. Hence, there'll be less tax receipts for the government and they won't make as much money as they are expecting. And because tax receipts have dropped and they're not making as much money as they're used to, that increases the amount of treasury bills that have to be issued to compensate for this lack of funding. And because of this recessionary period that will affect the globe, I believe, foreign governments will find that the US dollar is strengthening because it's harder to find now. Everyone's trying to sell what they can. The dollar is strengthening compared to other foreign government currencies, and governments have no choice, foreign governments have no choice but to sell their treasuries, return it back to the Fed. The Fed will give them US dollars, and this will increase the supply of US dollars globally as well. Now we have our government selling treasuries. We have foreign governments also selling their treasuries. We have a lot of supply of treasuries because they keep making them up and there's not a lot of demand for them. And when there isn't a lot of demand for treasuries, rates rise even more. That gets pushed onto our banks, and us, the people, the citizens or the civilians are the ones who put money into that during this recessionary period because we believe their yield is good. Wash, rinse, and repeat. So in option number 3, if Federal Reserve Jerome Powell steps back and he says, hey, the treasuries are coming in, but we're not going to redeem them for $1, and he lets the auction fail, there's a couple options that will happen over there. Essentially, in the short term, the US dollar will strengthen because there'll be more demand for it and less supply. With the government's debt to GDP being 120, right? And people are doing the math saying, hey, with the federal funds rate at 5% and the national debt is $31.4 trillion, they'll need to make this much. And because of tax receipts not being enough for the government to pay off their interest, there will eventually be a default. Even if, the federal funds rate continues to go up to say like 6%, right? The math will still support that there will be a default eventually in the future. And yes, that will strengthen the dollar, right? But it'll mostly bid up the gold prices. Gold will do very well. We can see potentially this happening where the Federal Reserve, whether it's Jerome Powell, he's still in office, he steps back unless the Treasury auction department fail, right? Where governments internationally won't be able to redeem for dollars. That'll create the scarcity mindset for the US dollar. We know that the government won't be able to service their debts with the amount of tax receipts coming, with the amount of treasuries they're trying to redeem for dollars as well. At a 120 debt, that'll be very difficult, right? And so the math will say, okay, what happens if it does fail? Well, what happen that will increase the bid of gold, that'll push up that price as well, and the world will restructure with gold as well. And this will help us if we do have assets to protect this from happening. Unfortunately, in this situation, the system breaks. It's very chaotic. It's ugly. So watch the last video in order to learn how to protect yourself in case of default. Okay, that's option number 3. So to avoid option number 3 and that calamity that may potentially take place, same setup, but now instead of Jerome Powell stepping away and the Federal Reserve stepping off and letting the Treasury market auction basically collapse or fail, they step in and they start buying up treasuries again and flooding the market with dollars, and everything goes up. All assets go up essentially except for bonds, right? Gold goes up in this situation again. Bitcoin does well. Oil does well. Everything pegged against the dollar in terms of exchange and currencies will do well because he's releasing the valve, right? The release valve will be the US dollar. The purchasing power of the dollar will depreciate. Prices will appreciate. The prices will be inflated again, and the cycle continues. This is, after we've experienced the recession, people are holding on to their liquidity. He releases the valves because he says, hey, there's so much treasury out here. The government's asking us not to default. The Treasury gives the Federal Reserve the Treasury bonds. We give them cash, and then the government's able to save themselves because there wasn't enough tax receipts. They're flooded with cash, and then the market goes from a recession and it goes back into a new cycle of bullishness. Commodities, equities do very well. Pretty much a lot of sectors do well. They put a cap on treasury bills, like 10-year treasury bills, like they did in the world wars. They say it's capped at 2 now. In that situation, things tend to do very well, including gold, like in the third option, fourth option. That's why I'm very heavy and I'm promoting gold quite a bit. But in this case also, Bitcoin does very well, other equities do well, other commodities do also do very well. As we saw, as the rebound came back from COVID, we saw the markets do very well in so many aspects. So that's essentially the 4 paths that we may possibly take. Option number 1, there's a revolution in Russia, there's a revolution in China, and things go back to the way they were pre 2008. Option number 2, we discover nuclear fission and we start to incorporate and industrialize our country and other countries as well, of our allies, and things go blossomingly well over there, right? Another hypothetical. Option number 3, the Federal Reserve steps back, lets the Treasury basically try to control their own affairs. They don't do a good job. There's a deflationary event. The US dollar also strengthens, but everything else drops, and that basically brings us into chaos and turmoil, right? Option number 4, the Federal Reserve may step back for a little little bit and let a recession come in, or they can step in earlier and they can support the market. This creates a huge boom and they flood the market. This creates inflation and weakens the dollar. They put cap on treasury bills, yield curve control, and this creates inflation amongst all sectors except for bonds. It does well for real estate, commodities, equities. Other currencies will also do very well, and that is the we go into a boom again like we did back in World War II, where the economy blossomed quite a bit as well, and we go into that situation, which I think is most likely because historically speaking, central banks, when they have this situation in front of them, they go with option number 4, right? That's just my opinion, but those are the options that we have available for us, and that's why markets really believe that option number 4 is the best option out of all of them, and that's why the markets are still so bullish, because they see the Federal Reserve between a rock and a hard place. And they said, hey, you're going to eventually pivot. Even if there's a recession, a drawdown of 15 to 20%, you're still going to step in, and we want to take advantage in case that does as well, right? So this is just my opinion. It's just my speculation. And this is my understanding of why I believe the Treasury bonds are basically the backbone of what's really happening internationally, including what we're experiencing here domestically with our banking crisis. In the long play, the Federal Reserve has to make that tough decision. If you were to ask me, what are the chances of this? I think option number 1 with those, China and Russia revolution and everything I explained there, plus the nuclear fission, discovery, and utilization, that's a very small chance, like a 5% chance, if not less. Option number 3 and 4, it's a coin toss today, but if you were to ask me a year from now, which one is most feasible during a recession, it would obviously be number 4, hands down. That's where I'm going to be putting my hard-earned cash down, betting on the system to be saved and swept in. As history has shows us, empires always make this move, countries always make this move. They always just inflate their currency and hence weakening the US dollar, and this will create an unimaginable boom in the industrialized world. All countries will start being huge. There'll be a huge prosperity on the planet because the dollar is weakening, meaning their currency is going to do well, and that's how the cookie crumbles. Thank you for watching till the end. Make sure to like this if you have learned something new. Subscribe if you haven't so you can catch the latest. And thank you for watching Financial Almanac. I'll talk to you guys later. Bye-bye.